Welcome. Accounting and Management Made Simple is your channel of choice where we break down complex and difficult accounting and management principles into simple, understandable concepts. Whether you are a student preparing yourself for exams or a professional looking to apply knowledge practically, this channel helps you to grasp and understand complex key topics with ease. Please subscribe, share, like, and comment. Thank you. Hello students. Once again, it is your Accounting Made Simple tutor, N Muchai, and I want us to solve a past paper question, a very unique past paper, November 2018 question 4. Like I've said in several videos, the reason we are answering quite a number of questions which are related to company accounts because of two reasons. Number one, I've always been asked by students very many times about doing company accounts questions. For an obvious reason, and that's the reason number two. In the CPA exam, chances of missing this question is almost impossible. And therefore, what we are doing, we are looking at the different past papers, and we are looking at the different examiner's traps, the traps that he uses to trap our students, so that we can undo each one of them. We can help you to know how to escape them. For every paper, every question that we are doing, there is a reason for doing it. There are some things we want you to learn from it, so that when the exam comes, you just enjoy yourself. It is very easy to score 20 out of 20 marks for every one paper or one question that you get. But practice makes accountants. Our 16 years of training accountants has proved to us beyond reasonable doubt. Those students who do a lot of practice find themselves enjoying the paper when it finally comes. Once again, if we are of help to you, please support us. Help us by subscribing, liking, sharing, and even hitting the notification bell, so that every time we load our new videos, we are able to inform you. Let's hit the ground running. November 2018 question 4 is a very interesting question, and one of the key reasons why I have brought this question on board is the issue of statement of changes in equity. The statement of changes in equity. Very few questions have this, and when it is tested, our students just struggle to handle this particular area, and therefore we do the question. The question reads, Zamzam Limited has authorized share capital of 100 million shares or shillings 1 each, and 20 million 8% preference shares of shillings 1 each. The following trial balance was extracted as of 31st December 2017. Ordinary share capital 50,000, 8% preference share capital 8,000, plant and machinery 34,000. Motor vehicle at cost 16,000, computer hardware at cost 5,000, accounts receivable and accounts payable, they are captured there. Corporation tax at the beginning of the year. Corporation tax. Remember, we have a trial balance at the end of the year. But this trial balance at the end of the year is showing us we have tax we were supposed to have paid last year, but it is still a current liability. And because it has not been paid, you got to add it with the tax for this year to know the overall tax, payable. Bank balance 10%, debentures, inventories, general expenses. We have purchases and sales. We have preliminary expenses, debenture interest paid, investment income, salaries, share premium. I like saying that as you read through the question, it should already be formatting your answer in your head. You should be having the format of the income statement, the balance sheet. Remember the format. If you don't know the format, you can still communicate to us through the numbers. If you don't know the format very well, the format, and I have always said that the format I train my students in FA1 is still the same format. I'm very keen to ensure that they will do the same formats when they are doing financial reporting in section 3, company accounts, and when they are doing published accounts. So the format is very, very, very important. My formats are the formats required by International Accounting Standards 1. Presentation of financial statements. So I'm very strict with the formats. So we have investment income, salaries, insurance premiums, investments, shares in gurus. Now, when you're told investment shares in gurus, the person is telling you that this is not a current asset. It is a non-current asset, because shares in a company, unless otherwise told that you are going to liquidate them in the course of the next year, they are supposed to be a long-term investment. Then you have accumulated depreciation, plant, motor vehicle, and computer hardware, director's fees, auditor's fee, computer software. You need to look at that and you ask yourself, why are we not having accumulated depreciation for computer software? It is because it's a current. Is an expense. Interim preference dividend paid, retained earnings allowance for doubtful debts at the beginning of the year. Then you are told inventories at the beginning of the year were valued as 247,000. So if you were to just start capturing our details, and we say the question is November 2018 question. It is CPA FA November 2018. Question 4. And therefore we are saying that our inventories are 28,247. Inventories 28,247. 28,247. Investment have a market value of 15,000. The rising in value of investment, unless we are told it was revalued, you cannot change the figure in the trial balance. So our investment will remain the figure in the trial balance, which is 13,500. If we are told it is revalued, then we debit the investment as we credit the revaluation account. For now, we have just been given the market value. We have not been told it was revalued. That's just there to confuse you. Debenture interest is payable in 2 installments. So we got to number 3. Number 3, debenture interest. And we know our debentures, we have 10% debentures amounting to 9 million. 10%. The interest rate is 10%, and the debentures is 9,000, which is 900. The debenture interest is 900, and we are told still at the trial balance, debenture interest is paid is 450. Less paid. 450, and therefore the debenture interest payable is 450. This is a current liability in the balance sheet, and this is an expense in the income statement. Then you are told insurance premium prepaid as that 1st of December 2017 is 240. So if we get our insurance account, and the insurance account, I'm looking at the trial balance for the insurance premiums. It is 750. Insurance premiums is 750. Balance brought down is 750, and we are told insurance premium, the one which was not spent, prepaid, is 240. Balance carried down is 240. Balance carried down. It was not spent. We paid insurance 750,000, but although we paid 750, we did not spend all the insurance. Some insurance will be spent next year. So it's a current asset, a prepaid insurance current asset of 240. So 750 minus 240, 750 minus 240, we get a figure of 510. So that's what we take to P&L account or the income statement. 510. Then we are told depreciation computation, depreciation expense. We have plant and machinery. We have motor vehicle. We have computer hardware, and plant and machinery is 10% on cost, 10%, Motor vehicle is 25% reducing balance, 25% on reducing balance, and computer it is 25% per annum, 25% on cost, 25% on cost. So we go to the trial balance, and we get the plant and machinery. We get plant and machinery, 34,000, 10% of 34,000. For the motor vehicle, the original purchase cost of motor vehicle, it is 16,000. It is 16,000, but we subtract accumulated depreciation at the beginning of the period. We subtract the accumulated depreciation for motor vehicle at the beginning of the period, and it is 7,200. 7,200 to get the reduced balance. The reduced balance is the original purchase cost minus the accumulated depreciation up to the beginning of the year, which is shown in the trial balance. But the others are at cost. Computer hardware, the cost is 5,000. 25% of 5,000. So we get our figures. We get our what? This 34,000 divided times 10, it is definitely 3,400. 3,400. And the others, 16 minus 16, 1, 2, 3, minus 7,200 times 0.25, we get a figure of 2,200. We get, but there is, we get, 16,000 minus 7,200, 16, 1, 2, 3, minus 7,200, 7,200 times 0.2 times 0.2, we get 1760. We get 1760. This should be, we are told that for the motor vehicle, it should be 20%. This one should be 20%. This should be 20%. And that is giving us 1760. That is giving us 17 what? 0.25 of 5,000. We get a figure of 1,250. We get a figure of what?
1,250.
1,250. That is, we are through with the depreciation. Then you are told allowance for doubtful debt is to be increased to 7,500. Allowance for doubtful debts. Allowance for doubtful debts. Account. The balance brought down. And balance what? And balance carried down. We are told our closing balance should be increased to 7,500. 7,500. And therefore, balance brought down at the trial balance, the last item is 5,300. When we have the two, you must always know, when we have the opening and the closing balance, the difference is what we take to the income statement. If it is increasing, it becomes an expense. If it is decreasing, it becomes other incomes. In our case, it is reducing, it is increasing from 5,300 to 7,500 minus 7,500, and the increase is 2,200. And therefore, we take the increase to P&L account as an expense. 2,200 is an expense, 7,500. 7,500 what?
100.
Then we are told a corporation tax of 4750 is provided for with respect to the end of the year. Every time we say provided for, we are saying it's an expense and a liability. You debit the income statement with that amount, as we say, less income tax expense, and you also record the current liability called tax payable. So we are saying tax payable. Tax what? I like calling it tax payable so that you can remember when you are doing your reality check, when we are doing your current assets. So we are told tax payable is 4750. 47 what? 4750. Then we are told, number 8, directors to propose to pay the remaining dividend due to preference shares, to preference shareholders. So preference dividend, we know it is the rate is always given at the trial balance. The rate for the preference dividend is given at the trial balance, but the rate for ordinary dividend is declared by the directors. The rate for the ordinary dividends is declared by the directors, but the preference dividend is shown in the trial balance. 8%. So it is 8% times 8,000. That must be something to do with 0.08. 0.08 times 8, 1, 2, 3, is it 640? 640,000. It is 640. Then, how much have we paid? We are told that we have paid preference dividends. Have we paid any dividends? Have we paid any dividends from the trial balance? Purchase, debenture, interest. Yes, interim preference dividend paid, amounting to 320. So less paid. Less what?
Paid.
Less paid, 320. So our payable, dividend payable, preference dividends payable. Preference dividend what?
Payable.
Payable. Is a current liability. Is a current liability. And then you are told first and final dividend to ordinary shareholders at the rate of 6%. So ordinary dividend at the rate of what? 6% times ordinary share capital. Times ordinary share capital of 50,000. Or 50,000. 6% of 50,000. 6.0506 of 50. 1, 2, 3. We get a figure of 3,000. You get a figure of what?
3,000.
So this is dividend, ordinary dividend payable. That is ordinary dividend what? Payable. Ordinary dividend payable is 3,000. Capture them because you will need them when you are doing the balance sheet. You need them when you are doing the what? The balance sheet. You need them when you are doing the balance sheet. You need them when you are doing the balance sheet. Now, something you will need to know about the tax here. Something you need to know about the tax here. We are told that the tax for the year is 47. We have not paid. We have not paid. We are providing for tax amounting to 47.50. So our income statement will show an income tax expense of 47.50, but the tax payable. Our trial balance shows that we have tax payable balance brought down. Our balance sheet shows a tax payable balance brought down of corporation tax payable at the beginning of the year, 1st of January 2017 of 1970. 19 what? 1970. Then P&L, we are incurring this year tax of 47.50. 47.50. So I will call this one tax expense. I'll call this one tax expense, not tax what? Not tax payable. So we add the two to get the tax payable in the balance sheet. To get the tax payable in the balance sheet, 1970 plus 47.50. 47.50. Get a figure of 67.20. Get a figure of 67 what? 67.20. So that is the balance carried down. That's the total liability, 67.20. We had a liability of 1970 at the beginning of the year. We incurred 47.50. Your balance of 67.20. 67 what? 67.20. 67.20. Then we are told a sum of 2 million is transferred to general reserve. Transfer to general reserve, 2 million. Transfer to general reserve of how much?
2 million.
2 million. From there, those are the adjustments. We prepare our Zamzam income statement. Our Zamzam Limited. Our Zamzam Limited income statement for the year ended 31st of December 2017. 31st of December 2017. And from there, we start with our sales. We start with our what? And if you look at the question, the sales has not been adjusted. If you look at our adjustments, we have not adjusted sales. We have not adjusted the what? So we go and we get it straight and we say sales is sales, our sales figure is where? Our sales figure is 233,384. It is together with purchases. 233,384. 233,384, and it is shillings in thousands. 233,384. We check what they are returning us, and there is none. So we say less cost of what? Of goods sold. Always remember your format. Cost of goods sold. We have opening stock. And our opening stock is there in the balance sheet, the trial balance. Our opening stock is in the trial balance amounting to 25,200. 25 to what? 25,200. So we add the purchases. We add what? Remember the format. Follow the format in the head. Purchases is 164,764. 164,764. 164,764. 25,200 plus 164,764. 164,764. We get 189,964. 189,964. We say this is cost of goods available for sale. Don't write in the short form the way I'm doing. I'm doing it because of space. For you, don't even do that even if you have a problem with space, because you get used to it. And you do this in the final exam, you will not get it correct. So, cost of goods, so we less closing stock. We less what? Closing stock. And additional information number 1. Give us the closing stock as 28,247. 28 to what? 28 to 47. 28 to 47. 18 minus 28 to 47. We get a figure of 161. We get a figure of 128 to 47. We get cost of goods sold amounting to 161,717. We get a figure of 161,717, and that is cost of goods sold. Cost of goods what? We subtract that from our sales minus 233,384. 233,384. We get a figure of 71,667 as the gross profit. 71,667 as the gross what? Remember the format. We always say add other incomes. Add what? Add other incomes in our format. Add other incomes, and we have one of the incomes, which is our dividend receivable, our investment income, which is dividend receivable because we have shares in Guru Limited. And from the trial balance, we have investment income amounting to 1125. So we add investment income from the trial balance amounting to 1125. Always check if you have it. Always check we have other incomes. So 71,667 plus 1125, we get a figure of 72,792. 72,792. That is aggregate income. That is aggregate what? Aggregate income. We say less expenses. Less what? Expenses. And when we say less expenses, we start with the adjusted expenses. We start with the adjusted what? Expenses. We start with the adjusted expenses. And if you look here, we start with the debenture interest 900. Debenture interest, or we call it interest expense. Interest, it is 900. Then insurance, 510. Insurance, 510. Please mark, I'm not capturing 750. I'm capturing 510 because 240 is a current asset. 240 is a prepaid insurance which is shown in the current as a current asset in the balance sheet. Depreciation for plant and machinery. Depreciation, plant and machinery. Capture in full, 3,400. Motor vehicle, capture in full, 1,760. Computer, 1,250. 1,250. Allowance for doubtful debt. Increase in provision for doubtful debt. Increase in provision for doubtful debts is 2,200. Please mark, I'm not taking, it's not the balance carried down that I'm taking to the P&L. I'm only taking the increase. If it was a decrease, I would have captured it as other incomes. Now that it is an increase, it's an expense. Now, preferred dividend or the dividends or the tax payable. Those are the ones which required adjustments. They are the ones that required what? Adjustments. So we go now to the trial balance to look for expenses which are there in the trial balance but did not require adjustments. They did not require what? Adjustments. Especially general expenses, 11,020. General expenses, 11,020. General expenses, 11,020. Preliminary expenses, 2,400. Preliminary. $2,400. Salaries, 24,210. Salaries, 24,210. Salaries, 24,210. 24,210. Insurance premium we have captured. Insurance we have captured. Investor cumulative depreciation. Directors fees, 7,000. Directors fee we have not adjusted. You have not adjusted directors fees. Don't be in a hurry. Don't be in a hurry. Maximum results requires you to be keen. 7,000. Auditors fees, 2,500. Auditors fees, 2,500. Computer software, 1,500. It's not a non-current asset. If it's not a non-current asset, then it's an expense, 1,500. Allowance for doubtful debts you have captured. So those are the ones which we were adjusting. Let's check. Let's do an addition and see how we go. 900 plus 510 plus 3,400 plus 1,760 plus 1,250 plus 2,200 plus 11,020 plus 2,400 plus 24,210 plus 7,000 1, 2, 3 plus 2,500 plus 1,500, we get a figure of 58,650. 58,650. 58,650 as total expenses. Total what?
Expenses.
Expenses. We subtract. We subtract the total expenses from the aggregate income minus 72,792. 72,792. We get a figure of 72,792. 72,792. We get a figure of 14,142. We get a figure of 14 what? 142. And that is profit before tax. It is profit before what?
Tax.
Before tax. So we say less income tax expense. Less income tax expense. And our income tax expense, we say it is 4750. 47 what?
50.
4750. 4750. We get a figure of 9392. 9392. 9390 what? This is profit after tax. That's profit after what? From the profit after tax, we are taught to transfer to general reserve. We say that we are transferring to general reserve how much? This one. Transfer to general reserve of 2000. Let's transfer to general reserve. Remember the format. Remember the to general reserve. Transfer to general reserve of 2000. So 93, if you subtract 1, 2, 3, we get 7392. 7392. Our profit after transfer. Profit after what?
Transfer.
Transfer to general reserve. There is a profit now which we can distribute as dividends to ordinary shares. We can distribute to ordinary shares and preference shares. So we say dividends. We say dividends, and we start with interim. We start with what? Interim. If you look at the trial balance, we have interim preference dividends paid. You have interim preference dividend paid. Interim preference dividend from the bottom, the third item, it is 320 preference dividend interim. So we have preference dividends. That one was paid in the middle of the year, 320. Then we have the final dividend, which is declared. It's a current liability. So when it comes to the final one, we say that the preference to be paid, the one payable for preference is 320. Preference, it is 320. This one, preference dividend payable 320. 320 has been paid, 320 is not paid. Then we have ordinary dividend of 3,000. Ordinary dividend. Ordinary of 3,000. So overall, it is 3640. Total gets to be 3640. Total dividends. Total what?
Dividend.
Total dividends. 392 minus 3640. You get a figure of 3752. You get a figure of 3752, and that becomes retained earnings for the year. That becomes retained earnings for the what? For the year. These are the earnings which we have not distributed to the ordinary shareholders or even preference shareholders, and we are now adding to the retained earnings which we have retained in the previous years. So we add retained earnings brought down. You add retained earnings brought down from previous years. Retained earnings brought down from the previous years. From the trial balance, the second from the bottom is 8470. It is 8470. So you add 8470 and you get a closing figure plus 8470 plus 8470. You get a closing figure of 12,222. 12,222. 12,222. That is the closing retained earnings or retained earnings carried down. Retained earnings carried down at the end of the year. The retained earnings carried down at the end of the year, and this is what we take to the balance sheet. This is what we take to the what? To the balance sheet. And therefore we keep it somewhere. We keep it somewhere where we cannot lose it. We keep it somewhere we cannot lose it. We keep it somewhere we cannot lose it. 12,223. 12,222. 12,222. Retained earnings. Retained earnings. 12,222. 12,222. So we prepare the balance sheet. We prepare but even before you prepare the balance sheet, there is something we have been told. Statement of changes in equity. statement of changes in equity. Now, statement of changes in equity, you get your profit, you get the movement, you capture the movement of the shareholders' funds. You capture the movement of the shareholders' funds. We have share capital, ordinary share capital. We have the ordinary share capital. We have retained earnings, ordinary share capital. We have retained earnings. And we have general reserve. You have general what? General reserve. So we get the balance brought down, the opening balance. The opening balance of all this, the ones which are balance brought down, you capture them. For ordinary share capital from the trial balance, it is 50,000. From the ordinary share capital, it is 50,000. We do not have retained earnings. We actually have retained earnings brought down of 84.70. If you go to the trial balance, our retained earnings in the trial balance is 84.70. Our retained earnings is 84.70. And our general reserve. Remember that these are the shareholders' funds that are captured other than preference share capital, other than preference share capital. The rest belong to ordinary shareholders. So you get the ordinary share capital, you get the retained earnings, you get a general reserve, which based on we do not have an opening balance. We don't have an opening balance of general reserve. Then you look at the profit for the year. Profit after tax, before any transfer to general reserve, you get your profit after tax, you subtract dividend that belongs to preference shares. And you get our profit for the year. Profit for the year is 87.52. Profit for the year is 87.52. Profit for the year is 87.52. 87.52. This is the profit that you have made. Profit after deducting tax and preference dividend. Profit after deducting tax and preference dividends. So we come here and we say ordinary dividend, and we know from the income statement which you have just generated, ordinary dividend is 3,000. So the profit, this profit after deducting the tax and preference dividend, you have 87.52. After that, then you subtract, but you bring it to the statement of changes in equity, then you subtract ordinary dividend, and then we talk about transfer to general reserve. We are removing it from the retained earnings, and we are taking it to general reserve, an amount of 2,000. An amount of what? 2,000. And we remove it from retained earnings, and we take it to general reserve. And our shareholders' funds will look like that. 84.70 plus 87.52. 84.70 plus 87.52. 87.52 minus 5,000. 1, 2, 3. We get a figure of 12,222. Our retained earnings figure, this one is that figure, 12,222. Our retained earnings figure, 12,222, is done that way. And then we come here, we say general reserve also will be 2,000. These are the balances that we show in the balance sheet as the shareholders' funds. We show ordinary share capital of 50,000, retained earnings of 12,222, and general reserve of 2,000. I want to reiterate here because this is an area that confuses students, and this is actually the key reason why I decided to do this question, because these type of questions are very rare. But we are saying this. We want to see the movement in the shareholders' funds. Funds. And according to when you come to section financial reporting, I don't want to introduce you to that now. We always say that preference shares are treated like non-current liabilities. Preference shares are treated like non-current liabilities. So the dividends that is attributable to preference shareholders is treated the way we treat interest expense. So you get the profit after tax, you subtract the preference dividend, the figure you get, you bring it to retained earnings. You bring it to retained earnings, but at the retained earnings level now, within the same of changes in equity, you subtract dividend. You subtract dividend and any other transfer to get your final retained earnings. So that's the way to go about it. These are the figures to show in our balance sheet. So quickly we go to the balance sheet. We quickly go to the statement of financial position. Zamzam statement of financial position. Zamzam statement of financial position. Zamzam Limited statement of financial position as at when? That year, 1st of December 2017. That 1st of December 2017. So we say assets. We say what?
Assets.
Then you say non-current. You say non-current assets. Remember, the assets must be organized based on their permanence. Based on their what? Based on their permanence, our assets must be placed based on their permanence. And from that trial balance, you can see the most permanent asset there is plant and machinery. And then you have motor vehicle and then computer hardware. So we say shillings, provision for debt, for depreciation, not debt for debt. And then you say net what? Net book value. So we say plant and machinery. The purchase cost of plant and machinery is at 4,000. From plant and machinery, the next most permanent is motor vehicle. Which is 16,000. And then we get computer hardware cost. Computer hardware. Computer hardware, it had cost 5,000. It had cost what? 5,000. Then remember what we said. You get the accumulated depreciation at the beginning of the year, and then you add a charge for the year to get the final charge at the end of the year. Plant and machinery, at the beginning of the year was 16,000 from the trial balance. 16,000 plus the charge for the year. The charge for the year we said depreciation on plant and machinery is 1760. The charge for the year is 1760. The charge for the year from the trial balance you get at the beginning of the year, then you add the charge for the year 1760 plus 1760, you get a figure of 17,760. You get a figure of 17,760. Plant and machinery depreciation is not 1760, it is 3,400. It's at 400. So we get the balance at the trial balance, 16,000. 16,000 plus 3,400, we get 19,400. 19,400. We get 19 what? 400. And then motor vehicle, from the trial balance, it is 7,200 from the trial balance. 7,200 plus the charge for the year. Motor vehicle now, 1,760. 1,760. We get 1,760. 1,760. We get a figure of 8960. 89 what?
60.
8960. Then computer hardware. From the trial balance, the accumulated depreciation at the beginning of the year is 1,750. So we get 1,750 plus the charge for the year, computer hardware 1250 plus 1250, we get a figure of 3,000. Get a figure of what? 3,000. Then we get the net book values. We get the net book values minus, definitely this minus this is 2,000. 89, 16,000. 1, 2, 3 minus 8960, 8960, we get a figure of 7040. We get a figure of 7040. Then 34,000 minus 19,400, we get a figure of 14,600. You get a figure of 14 what? 600. You add all of them, plus 7040, plus 2,000, we get a figure of 23,640. We get a figure of 23,640. Total non-current assets, total tangible, total PPE, that is total property, plant and what? And equipment. Total property, plant and equipment. The tangible non-current assets. Tangible non-current assets. But we have investment. We have an investment in group company, in company shares. Investment, additional, it is in the trial balance. The investment is the trial balance amounting to 13,500. 13,500. 13,500, 23,640 plus 13,500, we get a figure of 37,140. 37 what? Total non-current assets. Total non-current assets. Total non-current what? Assets. Total non-current assets, 37,140. Then we say current assets. You say what?
Current assets.
And always current assets, we start with inventory. Always start with inventory. And our inventory is given as 28,247, 28,247, 28,247. Additional information number 1. Then we come to, that is inventory. Then we come to accounts payable. Accounts payable. From our trial balance, our accounts payable, our accounts receivable, our accounts, sorry, not payable, it's an asset. It's an accounts receivable. Our accounts receivable. From our trial balance, our accounts receivable is 34,980. 34,980, 34,980. But always remember to ask yourself, do we have provision for doubtful debts? Do we have provision? And we said here that our allowance for doubtful debts is 7,500. So we subtract 7,500. We subtract 7,500. 34,980. 34,980 minus 7,500. We get a figure of 27,480. 27,480. We get 27 for what? We get 27,480. Then we have a prepaid insurance. We said you have prepaid insurance, and insurance, we said prepaid insurance was 240. Prepaid insurance was what? 240. Prepaid insurance of 240. Then we have bank. Then we have bank amounting from the trial balance. Our bank amounts from the trial balance. It is 1, 2, 3, 4 at the bottom. 1, 2, 3, 4. 14,505. 14,505. 14,505. So we add them to get total non-current, total current assets. 27 plus 240 plus 14,504, 505 plus inventory 28,247, 28,247, giving us a figure of 70,472, giving us a figure of 70,472. 472. 7472. Total current assets. Total current what?
Assets.
Then you add total current asset to total non-current asset plus 37,140. 37,140. We add to total non-current asset, that's 7,140. We get a figure of 107,612. We get a figure of 107,612. 107,612 is our total assets. Is our total what? Where did we get the funds from? So we say financed by equity and what? And liabilities. Equity and liabilities. Then we say equity and reserves. Equity and reserves. And we said ordinary share capital. Ordinary share capital, we said it is 50,000. From the shareholder, from the statement of changes in equity, ordinary share capital is 50,000. Then we have preference share capital. The preference share capital, 8% preference share capital of 8,000. 8% preference share capital of 8,000. And then we have general reserve. We have general reserve. The transfer to general reserve. We have transfer to general reserve amounting to 2,000. Transfer to general reserve. This format must be in your head. 2,000. Then we have retained earnings. We have retained earnings. We have retained earnings. Remember our format in the head. The retained earnings is 12,222. 12,222. That should be our total shareholders' funds. That should be our total shareholders' funds. So 58,000, 1, 2, 3, plus 14, 1, 2, 3, we get 72,222. 72,200 and what? 22. We have total shareholders' funds. Total shareholders' funds. Then we talk about non-what? Non-current liabilities. Non-current liabilities. And our non-current liability is 10% debenture from the trial balance of 9,000. 10% debenture from the TB of 9,000. Then we go to current what? We go to current liabilities. We go to current liabilities. And I'm going to delete this so that you can get the current liabilities from there. Starting always with either bank overdraft is always the beginning one in the format. Then we come to accounts payable, that is trade creditors. Then all the other current liabilities following. All the other current liabilities doing what? Following. All the current liabilities following. So our trade payables, our accounts payables. Our accounts payable, our liabilities. Our accounts payable from the trial balance, our accounts payable from the trial balance is 15,900. Our accounts payable from the trial balance, it is together with accounts receivable. It is 15,900. It is 15,900. So again, we quickly look in our workings to find out, are there other current liabilities? We have the debenture interest payable of 450. So interest payable 400 and what? 50. Once again, I want to repeat again. Please, if we are helping you, and I believe we are, kindly like, share, subscribe, and join our online classes. We have done this for the last 16 years, and I can assure you we remain the best in our region. So we move on and we get any other liabilities. There is interest payable of 450. We quickly check. Depreciation allowance for out of debt, tax expense 47. We know our total tax payable is 6720. Tax payable is 6720. Our tax payable is 6720. Preference dividends, preference payable is 320. Preference dividend payable. Preference dividend payable is 300 what? 20. And ordinary dividend payable is 3,000. Ordinary dividend payable is 3,000. It is 3,000. The tax payable we have captured. Ordinary dividend payable we have captured. So I want us to check through the trial balance to find out if we have any other liability, any other current liabilities which we have not captured from the trial balance. From the trial balance, I don't think there is one. I can see that there is one. So we try to add them up. 15,900 plus 450 plus 6720 plus 320 plus 123, we get a figure of 26,390. We get a figure of 26,390. That is total current liabilities. Total current what? Total current liabilities. Total current liabilities. And then we add our total current liabilities to total non-current liabilities to the shareholders' funds. If they equal to total assets, then it is balancing. If they don't, then we have made a mistake. So 26,390 plus 9,123 plus 72,123, we get 107,612. 107,612. And therefore they are balancing. So this is equity and liabilities. That's the way to do company accounts. That's the way to do company accounts. And I want to repeat again, the reason we did this question is the issue of statement of changes in equity. The statement of changes in equity is basically, the only trap there is one. We want to know our shareholders' funds. We actually get our shareholders' funds, these ones, we get these shareholders' funds, and we turn them around. We just get this and we turn them around. Just allow me to reiterate on that, because that's why we did this question. We reiterate on that. We just get the shareholders fund and we turn it around. We turn it what? We turn it around, and therefore we say ordinary share capital. We avoid preference shares, because I said in accounting we treat in line with the principle of substance over form. In line with the principle of substance over form as taught in financial reporting, we assume preference share capital is treated like any other liability. So we get ordinary share capital. We avoid preference shares. We transfer. We talk about general reserve. We may even be having many others. You may even be having revaluation reserve. You may even be having revaluation reserve. You may even be having share premium. You may even be having the share premium. Then we have our general reserve. We may have in general reserve, and then we may be having retained earnings. We may be having retained what? Retained earnings. Retained earnings. Now we know that our profits is retained earnings is retained profits. So we get the balance brought down. The opening balance of ordinary share capital, revaluation reserve, share premium, general reserve, retained earnings. Now, I want to repeat. If we are helping you, like, share, subscribe, and hit the notification bell so that when we have this kind of things, we are able to explain them to you. So you get the opening balance. You get the opening balance, and then you ask yourself what happened in the course of the year. Maybe we issued shares. Issued shares. We issued shares. This is the balance in the ordinary share capital at the beginning of the year. Maybe we issued shares. And as we issued shares, most probably, like when we are issuing through revaluation reserve, when we are doing light issue, we reduce our revaluation reserve as we increase ordinary share capital, and then we may even have issued using we have issued our shares, some of our shares at above the par value. So you have share premium. Then that has nothing to do with the issue of shares, and this has nothing to do with the issue of shares. So we say profit for the year. Profit for the year. Now, what do you get? How do you get a profit for the year? You get a profit for the year by getting the profit made in the course of the year minus preference dividend. Minus preference dividend, you get that profit here. Then, from this profit, before deducting transfer to general reserve, you come to deduct the dividend and general reserve here. So we come here and we say dividend paid, dividends, whether paid or not paid, dividend whether paid or not, so you subtract the dividend. You subtract the dividend and transfer to general reserve. Transfer to general reserve, you are removing from retained earnings, so you bracket it and you bring to general reserve. You bring to general reserve, and then you get the shareholders' funds at the end of the year. So balance as at 31st of December. This is balance at the beginning of January, 1st of January. So you get the closing balances. And when you now go to the balance sheet, you'll be picking from here. You'll be saying ordinary share capital, you take it there. Revaluation reserve, you take it there. Share premium, you take it there. General reserve, you take it there. And your retained earnings, you take it there. That's the way to prepare the statement of changes in equity. The statement of changes in equity. The only thing you need to realize very, very well, be careful. In this particular case, we are assuming that preference share capital is like, especially when it is redeemable preference share capital. It is like a loan, because at one point in time, the redeemable preference shares will be bought back. The firm will pay them back. Therefore, we treat it the principle of substance of our form dictates that we treat redeemable preference shares as loans. So it's not shareholders' funds. It is treated like a loan. And therefore, you get a profit after tax. You subtract redeemable preference share capital. Whatever you get, you bring it here as a profit for the year. Then from here, you subtract transfer to general reserve and the dividends to get the retained earnings being left in the accounts. Once again, thank you very much. Please like, share, subscribe. Help us to help you. By liking, sharing, subscribing, and even joining our online classes. Thank you very much.